Hey Arun, how are you?
Hey, hi, Prince. Very, very good. How are you?
All good, man. And for our audience, I would request you guys to circulate the link to a maximum number of people so that more people can benefit from the experience of Arun. And trust me, last 2, 3 sessions with Arun, this is again going to be very interesting at a juncture wherein we all believe that market is not that cheap, or some believe that the valuations are crazy. So this is a perfect timing, I would say, for this session, which we have titled Bull Bear or Bubble. So, Arun, I would request you to quickly, tell about some background in the sense we discussed your book last time, right? So, touch upon on that, and then we come to the topic so that those who are joining for the first time shall know about your book and the work you do. Please.
Yeah, sure. Thank you so much, Prince. It's always, I love doing these sessions with you. And as a backdrop, I currently head the research at a firm called Funds India. So we were one of in fact, we were the first digital wealth management platform in India. So we are almost close to more than 15 years. And roughly we manage somewhere close to around 14,000 crores of AUM. So this is our backdrop, and I have been here since the end of 2019. And earlier, I used to work with a firm called Wealth Advisors India, which eventually got taken over by 361 Wealth. So I was a part of the wealth management teams both at Wealth Advisors India and 361 Wealth. So effectively, initial part of my career was started in 2011. So it's almost been like 13, 14 years. So initially it was mostly dealing with HNI segment between say around 2 to 5 crores. Then 361 was a it was ultra HNI, mostly 20 crores plus ticket sizes. And in Funds India, we are we are in the mid segment, probably between say 20 lakhs to 3 crore is a large space that we have. While we have different segments, but this is one of the core segments here. So this is broadly what I do for a living. Apart from that, I used to run a blog and I still run it. It's called 8020investor.com, where essentially the idea was whatever I learned, could I share it in terms of how do you construct simple portfolios and how do you make money over long periods of time. So that's how I started, and then eventually I realized that there are a lot of stuff which I've written over a period of years. Then I thought maybe during COVID, I just thought I had a lot of time, so I thought I'll curate it into a book. And then eventually I realized writing a book was a lot harder. So it almost took 4 years for me to finish it off. So HarperCollins was my publisher. So I've recently published it. It's almost 3 months, and yeah, thankfully the response has been great so far. It's almost hit the halfway mark for a national bestseller. So I'm hoping that probably in the next 3 to 6 months it will become a national bestseller. It's a very simple book, which with the premise that for anybody starting out or who's already investing, how can we go with a very simple approach to investing? The book's title is 80/20 Money Makeover. Essentially, the idea is if you apply the Pareto's law, right? Most areas in our life, we realize that 20% of our efforts will actually can bring us 80% of our results. So the remaining 80% is mostly giving you only 20% results. So the idea is in investing or in managing our own money, if we can figure out that 20% of the efforts, then with very minimal efforts, that I just need to put 20% and I can still get a great outcome. Is this possible? Was the broad question which the book tries to answer, and again, it takes you for the entire journey from starting from scratch. How do you build different buckets, and within that, how do you build portfolios, and how do you reach financial freedom? So again, I've separated into different levels till you reach 5 times your annual expenses, and after that 5 to 25. And once you reach financial freedom, or you have enough money, how do you create a monthly income plan for your life? And the most important thing is there's an entire section dedicated for all the behavioral mistakes that happen. Mostly the behavioral mistakes are done from a theoretical standpoint, but here, like in my real life, I've seen a lot of clients, and personally, I've done a lot of mistakes. So mostly, I've realized that more than everything else, it's primarily a behavioral problem. So I've dedicated one entire section for that, where what are all the behavioral pitfalls that happen in a bull market, in a bear market, in a bubble market, in product selection, in SIPs, and that I've put together, and what is the solution. In fact, today's session is also probably will touch upon some of the behavioral problems that happen in a bull market, and the question that we have itself is again indicative of one of the behavioral pitfalls. So anyway, that we'll discuss during the session.
That's great, Arun, and I wish sincerely that your book become a bestseller soon. I got my copy, so I'll be starting soon, short on time, so yet to start. So definitely look forward to that. And coming to today's topic, wherein we will be discussing the mistakes and basically when we misidentify the cycles, right? So we can start with the session, Arun. As and when you stop, if I have any question, I'll ask to you. And once you complete the three scenarios are wherein the four factors are prominent, be it the profit cycle, valuations, liquidity, and sentiments. So we have discussion around that, and as and when you stop, we can take certain questions. Yeah.
Sure. Yeah, so I can start, right, Prince? This is clear.
Yeah, yeah.
Okay,
Go
there's
ahead.
some disturbance. Okay, so broadly, if you go back to the starting point for me, the first 7 years of my career, I was doing a lot of hard work on stock picking, on fund selection, and there was a lot of noise, right? So and I ended up doing a lot of mistakes. So in 2013, I tried to time the markets. There was a huge currency problem which happened. Markets tanked for a bit. Then I tried to get out, and then eventually I ended up getting in very, very late. And I did a lot of missteps in picking stocks. The mid cap, small cap cycle, I was out a lot early. So there were a lot of mistakes that happened. So by the time in probably 16, 17, I was like, what had happened? Like what had just hit me in terms of, it was almost like a bull market, and yet it never felt like a bull market. And then the realization a simple thought came that if I had just identified the cycle, that it was going to be a mid and small cap cycle for for 3, 4, 5 years, effectively I didn't need to do much after that, right? If let's say I just picked any mid cap fund or any small cap fund, I would have been through. And similarly, when I looked at US, it was just that if somebody could have identified the cycle right now, leave the stock selection, leave the fund selection, and you just bought either S&P 500 or Nasdaq, you were through. Similarly, if you look at the last 4 years, right from COVID, or let's say even in 2019, if you just got the cycle right, even if you put it in Nifty 50, right from 2020 start, which was just before the COVID, you have still made 17%. And if you did Nifty 500, you were around 18, 19%. So effectively, the starting point is a very simple idea that if you get good at identifying the cycles, probably 70% of your job is done. The remaining, mostly, even if you goof up, you are still okay. So overall, the idea of my investment process is divided into three parts. One is identifying the cycle. So any equity market, you can classify them into a bull market, which is what all of us want to happen, where you actually make a lot of money, and then the bull gets overextended to a bubble market, where the probability of a large crash of say around 40, 50, 60% increases, and a bubble is followed by a bear market. Then again the cycle continues. So the first realization was, if you get reasonably decent or good at identifying the cycles, probably this in itself can contribute 60-70% of your overall return. So this is as a part of the 80-20 investment philosophy. This is that important 20%, which if you get it right, more or less you are through. Then even after that, if you don't want to do fund selection, you don't want to spend time on sectors, you don't want to spend time on stocks, you will still be okay if you just get these cycles broadly right. So the other thing is that it's broadly right and not precisely, because it's almost impossible to precisely time these cycles. So this was the first starting point. And then once you get this cycle right, And then on top of it, if you get good at building a decent equity portfolio, which can say outperform the index, then there's the second win. Then probably this can add another 20% to your overall outcome. So 70% comes from identifying the cycle. 20%, I mean, these are like just like a mental way to think about it. They're not exact. I mean, you can't measure it, but broadly in terms of importance, that's how I think about it. The last 10% is for experiments that you want, that some good stock has kind of fallen like crazy and just you want to take it might be a sectoral call or might be a stock call that you want to do. This is just for doing that excitement, because otherwise life gets boring and all that. But this is something that you can even knock it off. So, but I would contribute that to 10%. So broadly, my journey at Funds India has been about building frameworks for all these three levers, and the broad context being, if I get the lever one right, which is if I can identify the market cycle right, more or less 70% of my clients' problems are solved. So this is how I think it through. Now, why is this very, very critical? Because most of us in hindsight think that bull markets are super easy to make a lot of money. But the real challenge in a bull market is that the behavioral problem in a bull market is that at all points in time during a bull market, a lot of people will assume or misdiagnose it to be a bubble market. Now, if you look at right from the start of 2020, at all points in time, I've consistently read somebody or the other calling for a bubble. There have been several sessions which I've attended where it said all time high, is it a bubble? All time high, is it a bubble? So we ourselves used to write blogs at all time high. So this is probably the day I entered Funds India in 2019, I wrote a blog and somebody scolded me saying, hey, you guys will always say like this. And so I also felt like, oh, maybe we are also kind of getting too biased or something like that. But the point is that every time it always felt that it was a bubble. So the key point is that in hindsight, it looks like bull markets are very easy. But the real problem is that at all points in time, you kind of there is a temptation to misdiagnose it to be a bubble. So the critical part of it, and how do you misdiagnose it? One, every time it hits an all-time high, you feel that it's probably a bubble because it's a human tendency. Second is there is always some bad news which comes, and if there is a 10% correction, let's say tomorrow there's some bad news and the market goes down by 15%, you will feel that, hey, probably it was a bubble and it's a time to take out the money. And then the third level is there is some expert either from India or from global calling out for a bubble. And this is like it's almost become like a hobby where a lot of people keep calling for bubbles, and once in a while it happens and then they end up writing books and all that. But it's very, very hard because the newspaper headlines are that this person who predicted the 2008 crash or 2020 crash is also predicting another bubble today. So it's very, very hard to resist them. So these are the three big trigger points where we start assuming it to be a bubble. And again, today when we talk, we are again at all-time highs, and then the trigger point is there, right? So there is a large temptation, and I know a lot of people who have taken out the money at 60,000 levels or 70,000 levels and are still waiting for those. Now they are like, even if I get it back at that levels, I will be more than happy to invest. So the underlying thesis is that behaviorally a bull market will look super easy in hindsight, but during a bull market there's a lot of tendency to misdiagnose it to be a bubble market. And again, overextending this, the same thing can happen in a bubble market where I can probably misdiagnose it to be a bull market, and then I will overextend myself in a bubble market. So the trick is, how do we put some framework so that we can think through what is a bull market, what is a bubble market, and what is a bear market. Now, a bear market is fairly simple for all of us to at least agree on, because bear market means market has fallen. So if you say a cutoff of 20% fall, so let's say today we are at 80,000 levels, right, at Sensex. Now if we say a 20% fall, which means approximately 16,000. So which means if it comes below, say 64,000, you can say that, hey, markets have entered a bear market. So there the definition is fairly straightforward. And depending on did the bear market start from a normal condition or from an abnormally high bubble market kind of a condition, you can decide on a plan on how to put more money into equities, because in a bear market usually once you increase equity allocation, you end up making a lot of money, provided you are able to patiently wait it out for the next 3 to 5 years. So bear markets are a great time to enter. Now, so bear market problem is solved, that effectively the definition is 20% fall, and whenever it happens, it's very, very easy to identify it. And if it starts from insanely high valuations or insanely high zone, probably instead of 20%, you slightly modify it to say 30%. But the broad idea is it's a lot easier to identify and agree upon. So the real challenge is between a bull market and a bubble market. Now the good part is that I don't need to identify both, but if I identify a bubble, then whatever is remaining can be agreed upon to be the bull market, or probably a boring market. Bull will also consist of boring market, where market does nothing. So in fact, even in this bull market, there was in between, I think it was around 2022, where nothing happened in the market for almost 1.5 years. We were stuck at the same levels, and then again Sensex started to shoot up. So the broad idea is bear market is super easy to identify, because anytime it falls below say 20%, you can say it's a bear market and put in place a plan for that. And then similarly within bubble and bull, if we can put some framework to identify a bubble, you can say that as long as it is not a bubble, in a bull market, all I need to do is just maintain my equity allocation. So if let's say I am almost a 90% equity allocation. So all I need to do in a bull market is just maintain it around that level, because as a bull market progresses, the 90 might become 95 or 96. So for a 5% deviation, I bring it back, and somebody else might be a 50% equity allocation. So again, the same thing they do. As the bull market keeps increasing the equity allocation levels, you bring it back to 50 every time it crosses past that 5% band. So once you identify a bull, once you say it's a bull market, all you need to do is a simple asset allocation strategy. Similarly, in a bubble market is where you might want to go underweight on equities, and in terms of the degree and all that, it's an individual choice. But this is how the actions will broadly have. So now the key question is, all I need to do is, if I put a framework to identify a bubble market, then more or less most of my problems get solved, because whatever in a bear market it is down by 20-30%, and if it is not a if it's not a bubble market, then most likely we are either in a bull or a boring market, where I just need to stick to my asset allocation. So how do we identify a bubble market? Now usually it's if you broadly think about it, there was a very interesting quote on Twitter which I saw, which essentially said, if you have to try to convince an average person, you act overconfident, or you act very confident. And then if you are trying to convince a very intelligent person, you act very cautious. So effectively, if I try to be very pessimistic, then I find a lot of resonance with all these intelligent folks. So if you really think about it, it's super easy to call for a bubble, because you say, hey, the valuations are expensive. Look at the FNO trading options that are coming. Look at small caps, the amount of interest that's coming. Look at the NFOs which are getting launched. So there are a lot of data points that you can quickly collect and then say we are in a bubble. Similarly, we can collect a lot of points and then say, hey, probably we are not in a bubble. So you will find different people coming up with different data points, and it's super easy to pick and choose what you want. But effectively, because we have our own money in invested, for us it's very, very critical that we don't get carried away by narratives coming from different folks. So what we need to have is fundamentally a framework where there are different lenses through which you are analyzing the market without any biases, and under each lens find out what is that lens telling you. And then as you get different data points from different experts, you plug it into that particular lens, so that overall you'll have a holistic view. It's again, the template is broadly on how that there is this Indian elephant story, right, where 5 blind men are touching the elephant at different places, and then they are saying, one is saying it's a tree, one is saying it's a spear, one is touching the ear and it's saying it's a fan. But if you take a step back, you identify that it's actually an elephant. So that's the same approach that we'll do. Now, what are those 4 lenses that we will apply? The 4 lenses is, one is the fundamental lens, where we essentially ask the simple question, where are we in the profit cycle of, because ultimately profits drive markets over the long period of time. So where are we in the profit cycle? And profits go through cycles. There are periods where profits are subdued, and there are periods where profits are very, very high. So 2003 to 7 was a period where profits of Indian corporates grew by almost 25% plus. And then for a long, almost like 2010 to 20, the growth was only 5% plus. And now we, again, the last 4 years, we are at 20% plus. So broadly, what you see is that they go through different cycles, and if you can get the cycle right in terms of profit cycle, then you are that this is the fundamental part. So once you get the profit cycle approximately, it's very difficult to predict what will happen, but all you can know is that where are you currently in the cycle, and this itself will give you a good sense. So that's the first thing. Second is you look at the valuation lens. Third is you look at the liquidity lens, where you essentially ask what's happening to the flows. So you get a sense of the supply and demand, and also you compare it with the IPO supply that's coming in. Then the last lens is the sentiment lens, where you are essentially saying, are people acting, are taking too much of, or are they getting very comfortable, taking a lot of risk, or are they very scared? So basically you're asking, are people getting greedy, or are people getting fearful? Now this is the approach that we are going to apply. Now fundamentally, let's start with the earnings cycle or the profit cycle. The first simplest question that you ask is that fundamentally markets have to track earnings growth over long periods of time. Now if that is the case, then you ask the simple question that, hey, last 5 years, what has been my earnings growth for the Sensex or Nifty, whichever you want. Now BSE Sensex, if you look at the EPS growth for the last 5 years, which is pre-COVID, so you are starting from, there is no base effect, so you're starting from almost June 2019 till June 2024, the earnings growth is roughly been around 17%. And now the question that you ask is my fundamental growth in my markets also in line with this, or is it exceeding, or is it underperforming the earnings growth? Now, if you look at the Sensex returns, Sensex is around 15%. You look at Sensex TRA, where you add back the dividend yield also, it's roughly around 16.4%. So broadly, the first takeaway, if you forget the entire presentation, it's fine. But the first takeaway is that you always ask, what is the last 5 years earnings growth? 17% is what happened in Sensex. And what was the Sensex growth? 16.4%. So you can see that markets have followed the fundamentals or the earnings growth. So this is a good starting point, that it gives you confidence that, hey, there has not been much of excesses getting built. Just to put that in context, in 2003 to 7 cycle, the same, by the time when you are ending the 2007, so when we were say close to the 2007 end, right, the earnings growth was 25%, whereas the market return was almost coming close to 45-46%. So this is 5-year CAGR. So you can see that almost, while the underlying fundamentals were showing that you should grow at 25%, we almost grew at 45-46%. So there was a 20% CAGR excess that got built. So that was the 2008 cycle. So this is a good metric that you can always look out for in terms of when is it going to exceed. So I think usually what happens in a bubble is that there is always a good fundamental earnings growth which happens, but the market overdoes it, because after a long period of time, the market assumes that the earnings growth will continue to surprise, and it will start front-ending a lot of future growth. So whenever you see a huge mismatch in the 5-year earnings growth and the 5-year equity market returns, then you need to get concerned. So level 1, that is not a problem today. Now the next thing for us fundamentally is that ultimately markets will follow earnings growth. So which means I need to understand what will roughly be my earnings growth over the next 3 to 5 years. Now how do I figure that out? Now over long periods of time, while there are certain countries where earnings, where the market returns are very deviant from the nominal GDP growth, at least in India, the market returns, the nominal GDP growth, and your earnings growth more or less tend to remain very similar over long periods of time. So if you look at the period between 1993 to 24, which is roughly a 30-year period, the Sensex return was roughly 12%, right? And then you add dividend yield, probably it was 13.5%. And then the nominal GDP growth was roughly 12.5%. Then again, the Sensex EPS growth was roughly 12.5%. So you can see that over long periods of time, all of them kind of are very, very similar. But however, in short periods of time, you see that the earnings growth is very, very less compared to the nominal GDP growth. And there are periods where the earnings growth is very, very high compared to the nominal GDP growth. Now, the good part of nominal GDP growth is fairly a stable number. And usually you'll get a lot of estimates either coming from the RBI or the government of India. So roughly, you know that currently mostly everybody is expecting around the 7% band, and you assume a 5% inflation. So broadly you're looking at a 12% number. Now all that you're asking is this a period where my earnings growth will be much higher than nominal GDP, or my earnings growth will be much lower than my nominal GDP growth? Now how do we know that? There is a number called profits as a percentage of GDP. Now this is a cyclical number. If you look at it, this is published by different security agencies. So one is published by ICICI Securities. So what they do is they take the entire listed universe and look at the overall profits of all companies put together as a percentage of GDP. Now in the bottom of cycle, it in 2001-2 period, it went as low as 1.7%. By the time it ended that cycle, the profit growth cycle, in 2007-8 period, it went as high as 6.5%. So every time it goes to between that 2% to 6-7% is where that significant profit growth happens. And again from 7% it went down to 1.6% in 2020. So which is why from 2008 to 2020 you had a very, very low earnings growth period where the earnings growth was 5% while nominal GDP continued to be somewhere close to that 11-12% band. Now again in 2020, if you ask why were we positive, and in fact even during COVID we had written a lot of blog articles saying it's definitely a time to invest more. It was a very simple reason that the net profit to GDP was somewhere close to that 2%, and in fact it went as low as 1.6%. So while it's hard to predict exactly when the cycle will turn, but whenever your profits as a percentage of GDP is very low, close to the 2%, you actually don't need to worry much. All you need is a little bit of time frame and then you are sorted. And again, when it goes to extreme, close to that 6-7-8% band, then you need to get worried because most likely you are probably at the end of the cycle. So the earning cycle will have three phases: early stage, mid stage, and the final or the late stages. So the question is, where are we now? Currently, if you look at the number, is somewhere close to 5%, and my sense is this cycle might go on till say around that 7%, 8% kind of a number. So in that, if you go by this metric, we are probably still in the mid cycle, right? So which means that if the number goes from say 5% to 6% or 7%, so it means I will have a growth which is much higher than nominal GDP growth because my profits as a percentage of GDP is also increasing. So if you roughly work the math out, it looks like we are probably the cycle is telling us that you are looking at an earnings growth environment of say around 15% plus. Now it's very difficult to precisely tell it, but we might also get surprised on the upside. But broadly, it says 12 to 15% should be kind of a good expectation. And if you get, and there's also a good chance that you might get more than that also. So this is what the cycle tells. Now the key point is, what will drive this cycle? Because the first, now to understand why did it go from 2% to 5 and what will drive from 5 to 8? Because this is broadly the cycle, but if we understand what goes into it, then it becomes a little more easier. So here is where three important things come into play. One is the capex cycle. The second is the credit cycle, or essentially you start taking loans, or the company start taking loans and then expanding. And how to analyze both of the capex and credit cycle, a good way to do is you can also study the entire financials of the Nifty 500 ex financials company. So if you can study the entire balance sheet and the ROE numbers, you will get a good picture. So these, I mean, it's obviously it's better if I have a visual presentation, but anyway, I'll try to explain. Now, you might have heard a lot of people say capex is the most important thing in terms of profits growing. Why do everybody harp on this capex, right? It's a very a simple logic. Now, if you think about it, let's say I am running a company and then I spend say 100 crores buying a software from some other company. Okay. Now this 100 crore project that I've put in for this, so for me as a company, my profits go down by 100 crores because I am spending 100 crores. And then similarly, the other companies, assuming that there's no cost attached to it, the other companies' profits increase by 100 crores. But so effectively, if you look at that company's profit, it goes up by 100 crores, but my profits comes down by 100 crores because I'm spending that 100. So at an aggregate level for the country or the entire set of companies, right? Net, there is no increase in profits. Okay. So this happens when you are buying, you are spending on services, or you are spending on some consumption related item. But let's look at the same thing where instead of this software that I'm buying, let's say I am buying I'm putting up a large plant. Let's say I'm putting up a manufacturing plant for 100 crores. Now the same thing, let's say there is a contractor for whom I am giving that 100 crores, that person will set the whole factory up. So I lose 100 crores. The contractor's profit goes up by 100 crores. Net it should be zero. But here is where the fun begins. Now the entire 100 crores which I spend, I do not show it in my profit and loss this year. I will say that, hey, this factory will last me for the next 10 years. So I will depreciate only 10 crores, while I've already spent my 100 crores, but I will depreciate, or I will show only 10 crores in my profit and loss. So which suddenly means that at an aggregate, while the other person has made 100 crores from you, and at the same time you are only showing 10 crores as the spending, because you are going to, you're showing it as depreciation, and you're going to do it over a period of 10 years. So which means suddenly both of us at an aggregate, we are up by 90 crores is the increase in profits, right? So this is why once the capex cycle starts, the earnings growth grows crazy. So always the first level of earnings growth comes when if you are a company, so let's say I'm running a hotel, or let's say I'm Royal Enfield or some manufacturing company who's manufacturing bikes, right? I don't initially put capex. I will put it only when, let's say, I can manufacture, 1 lakh bikes. And then my capacity right now, the demand is only 70 lakhs. Then, the demand is only 70,000, right? Then I don't do anything. I don't put plans because I still have another 30,000 excess capacity. But the moment it comes to say 80,000 or 85,000, then I start getting worried, because I know if the demand continues to grow, the next 2 years, I will have far more demand. I will have more than 1 lakh bikes which are being requested by my customers. But by the time I put a plant, it will almost take me, I need to get a large land, I need to get the manufacturing setup, I need to get employees. It's at least 2-3 years away. So which means I will need to start planning right now. So the capex would probably start 3 years back, before once you are at say 75, 80, 85% capacity utilization. So the first level of earnings growth will always come because of operating leverage, where you are not putting any extra money on putting a new manufacturing plant, but your manufacturing plant's capacity utilization is consistently increasing. So because your fixed costs are the same, but from selling the same 1 lakh units per year plant, from selling 60,000 units is now going to 70, then it's going to 80, but more or less the fixed costs are the same. Right? So it's like, think about it like an airlines, right? If it's an 100-seater airlines, Even if 50 people are only there or 80 people are there, the fixed costs are the same. So if instead of 50 it becomes 80, then suddenly you get insane amount of profits, because whatever comes extra straight goes into the profit, because the fixed expenses are already taken care by probably the first 30-40 seats. So this is exactly what happens at an aggregate level. So so what we do is we take all the NSE 500 companies, we remove financials, and we look at their aggregate sales, profits, total assets, total debt to equity, the capacity utilization, or in other words, the asset turnover, the ROE and all that. Broadly, 2-3 things matter, right? If you look at the FI 99 cycle, we were at somewhere close to 1 time debt to equity, which was the highest level. And slowly over the next 4 or 5 years, we started paring down the debt and the asset turnover, which we were at capacity utilization of almost 70%. Then slowly by the end of 2003, it came to 0.9, which is roughly 90% utilization. And the ROEs, if you look at it, when the cycle started, it was very low at 10%. Then it slowly came down to, it increased up to 20%. Now think about it at an aggregate, the Nifty 500 the debt had become lower, the capacity utilization had increased, and your ROEs were 20%. Now you are making insane profits, but your capacity utilization is getting done. And if you put it in FDs, you are probably getting 5% yields, whereas in your own business, you are making 20%. So this is usually when the capex starts. The same cycle, and then the FI not 5 to 8 was the biggest capex cycle, which is why you had a fantastic earnings run and also an insane bull market that happened. Now we are almost at a similar setup, because from 2010 the whole cleaning up of balance sheets had happened. Excess leverage got built. So by 15, the debt to equity became 1. And right now we are at 0.6. So we are at the lowest in the last 15 years. Similarly, the asset turnover, which was at 0.6 in FY20, right now is at 0.8. So which means roughly we have come to that 80% plus capacity utilization. And the best part is that the ROEs, which were at 10%, 12% band, is slowly come up to 15-16% today. So at some point in time in the next 1 year, or most companies would have already started. So you have very low debt. The asset or the capacity utilization is almost hitting that 80-85% number, and your ROEs are also moving towards that 15 to 20% band. So obviously, and your debt is giving you only say 7% return. So at some point in time, companies will say, hey, the cash is coming. I mean, the profits are insanely, there's a lot of profits coming. So I will need to start putting capex. And when capex happens, as I told you, it leads to insane amount of profit growth. So that PAT to GDP number to go up will need this capex cycle to start. But at least going by the history, it looks like a perfect setup for a capex cycle to. Now I'm not saying will it start or not, I don't know, but the whole idea is you identify where are you in the cycle, and the cycle shows that right now if you give it time, most likely the capex should start. And then again, the other metric that we kind of look at is this in terms of the capex cycle is gross fixed capital formation as a GDP. It roughly goes as high as 36% in the previous cycle. It went from 27% to or to almost 26% to 36%. And this cycle again, it has come down to 27% in FY21. Now it's at 30%. So again, by the end of the cycle, so if the number was somewhere close to 34-35%, I would be worried. So right now what you have seen in the cycle play out is only the operating leverage. So which is effectively the profits to GDP from sub 2% have come down to 5%. Now the question is from 5 to 7 or 8% will require this gross fixed capital formation to go up. So when would I be worried? If this gross fixed capital formation comes close to that 35-34% number, the PAT to GDP will automatically go up once this number goes up. So that will also come close to 7-8%. And you will see the corporate starting to take debt. So again, if you look at debt to equity, we are at 15 years low. That number will start going up. And this will also get reflected in the credit growth cycle. So we were almost stuck at sub 10% band for 5 years till 2021. And then now we are again back to the 16-17% band. But in the previous cycle, we went almost at 30-35% was the credit growth that we saw. So at least if it goes somewhere around 20-25%, I will start to worry. So both credit growth cycle, the gross fixed capital formation cycle, and the entire Nifty 500 balance sheets are showing that the capex, I mean, there is still probably you are done with the first half of the earnings growth cycle, which is driven by operating leverage, but the second half of the earnings growth cycle, which is usually driven by capex, is still not started. And usually markets try to preempt this and put that in the prices, but thankfully, as you saw the last 5 years, the both earnings growth and the Sensex returns are very, very similar. So which means the markets have not front-ended a lot of this growth. So the broad profit cycle setup is saying that, hey, we don't need to worry. It's probably we are done with first half, but the second half of earnings growth is still there, and most of you might be surprised on what can happen once the capex cycle, now whether it will start. So there will always be negative comments, because even in 2020 when the PAT to GDP was 1%, it's very hard to tell what will drive the profit growth up. But you know that once it's low, right, it's just like valuations. Once it's cheap, you just buy, because you don't know what will be the trigger that will go. So I've realized it's very tough to rationalize exactly why, because there'll be hundred of negative things saying, hey, this is not starting, that article I read, this article I read. But broadly, the way I do it is, if the cycle is at the bottom, I just don't overthink it. And if I give it time, most likely the odds are by my side. So similarly, the capex cycle, all indicators are that it should probably start. And if you give it a 3-4 year cycle, most likely it will play out. So this is, so broadly the first indicator is showing that we are still in the mid stages, right? And once the final stages happen, I will worry. So the first indicator, which is the fundamental profit cycle indicator, is showing a green, or rather a yellow. So we don't need to worry. Only when it goes to red, we need to worry, which is the late stage of the cycle. Second is valuations. What we do is we use a number called Funds India Value Meter, where we put together price to equity, price to book, and then market cap to GDP, and then earnings yield compared to bond yields. We put them as one concrete number. There are 5 bands in it. We were earlier in the fifth band. Now we are in the 4th band. So we are expensive, but again, it's not crazy expensive. So this is again a red indicator, but you should always put this in context with where are we in the earnings cycle. The other way to proxy this is you can also look at the BAF models. BAF is a category where fund managers of different AMCs increase or reduce their equity allocation based on their valuation model. Most of them, ICICI, Kotak, DSP, White Oak, most of them are indicating that valuations are expensive, but not insanely expensive. So that's where most of the BAF models are also indicating. So broadly, from a valuation point of view, we are in the expensive zone, no doubt. But again, this is red indicator, but again, you have to wear the first lens and put this valuations into context. Now the third indicator is the flows indicator, where essentially the idea is simple. If you are in a bubble, then both your FIIs and DIIs, who are the largest buyers, should both be positive. So usually in a bubble, everybody has a unanimous view. Now thankfully for us, from October 21, so almost like 2.5 years plus, what we have seen is the FIIs have barely participated. They are still they've still net. They put in money, they take out money, they again put in money. So I think net, when I last checked, it was somewhere around that sub 20,000 crores is what net they've added from October 21. But if you look at the same number for what the DIAs added, you would be shocked. We added almost 7 lakh crores in that period. So, and usually FIIs also are a very, very strong buyer in Indian equity market. So which means at some point in time, if FIIs also start coming back in, that is when I will get really worried. Because right now, if you look at FIIs ownership in NSE listed universe, we were at high around FI 14-15, we were at 22%. Now we are sub 18%. So which means FIIs, and then again, the same time FIIs exposure in emerging markets, the India's exposure is almost 18% plus, compared to 9%, below 9% in FY20. So which means in all the emerging market indices, India's exposure is going up, but still FI money is not coming in. So whenever they come in, and historically we've studied, there were almost 7 occasions where FI was negative over 1 year time frame. And every time when you invested in that period, you ended up making great amounts of money in the next 2 to 3 years. So again, FIIs being weak is a green signal for me. But if FIIs become positive, and DIAs are already crazy because SIP flows are strong. Our salaries are also a part of it, goes through the PF forcefully into equity. So there is a huge flow which is happening in the domestic money. So, but once FIIs go, then the two big buyers have become positive. Usually that will be supplemented by a strong IPO cycle, because then it means the promoters are also starting to sell. So it's just about started, but nowhere close to what we saw in 17, 18 or the 20 cycle. So again, when will I be worried? When the IPO numbers go crazy, when the FIIs are back and the DIAs are they're already positive. So if all these three numbers go crazy, then I get worried. We also track promoter buying, that is also at a low level. So it is, so if so the only two things remaining for me to become red is the FII buying and the IPOs starting to reflect in a very large number. So right now, if you look at the last 12-month rolling, what is the primary equity issuances, it's still manageable, but my sense is the IPO supply will start to flow in the next few months, and we'll have to see how this plays out. But these are the numbers that I watch out for. So right now the flow indicator is not showing red signal. So there's nothing to worry here. And the last signal that we look at is sentiment. Essentially, we ask, are we greedy or are we fearful? So broadly, you look at a lot of NFOs are happening. If you look at most of the inflows in mutual funds, it is 50% of the money that get invested every month is invested into small caps or sector funds, which are the most riskiest across equity funds. So which shows that people are getting greedier and taking a lot more risks, and the number of new investors who are adding demat accounts had slowed down, but it's again starting to pick up. And if you look at the leverage, both the derivative volumes have gone like crazy, and SEBI is also concerned. So all this, the VIX indicator is very, very low, showing that there's hardly any volatility there. So all these are showing that we are moving towards greed. But usually in a bubble, the last 1 year returns or the 6 months to 1 year returns goes bonkers. Historically in all bubbles, it's been around that 50% to 150% kind of a number. And this comes in after a very, very strong growth phase. So that very, very sharp parabolic move in prices have also not happened in the large caps. See, all that I'm saying is purely on the large cap space. The small and mid caps will have to be dealt with in a very separate manner, but this is broadly at the larger space. So now if you put all these things together, right? So the last indicator, sentiment, is showing that we are almost there in the greed zone. So which is again a red indicator, and the valuations are in red. So we are not in the last band, but we are one band below the highest valuation band. So both of these are red, whereas the flow indicator is still in yellow or in green, because the FIIs are still not back and the IPO cycle is still not started crazily. And again, the best part is earning cycle is clearly in the mid cycle. So once you put all these four together, we are definitely not in a bubble. Now, what is a bubble? Can it fall 10-20%? Historically, last 43 years, if you study, almost 10-20% fall is a given. Last few years might be an exception, except for 4 years, out of which one was last year. Every year we've had a fall of more than 10%. So which means if the market suddenly corrects by 10-20%, it doesn't mean that it's a bubble. Now, the bubble means it has to fall by 40-50%. So which means if there is any negative trigger, it pulls it down to 40-50%. So my sense is, unless and until these four become red, I would say that we are definitely not in a bubble. Can we move towards a bubble? We can, but these are the four indicators that you will have to consistently keep checking. And as and when you are looking at some interview and some indicator is being thrown at you, don't just go by that indicator, because the human mind will only fix on that. You just pick that indicator and figure out under these four, where do I map it in? And then once you see all this, you get a much better picture. So broadly, our sense is that we are in mid-cycle. We are not in a bubble, and obviously we have not fallen by more than 20%. So we are not in a bear market. So in a bubble, the strategy is stick to your equity allocation and play it. Now, as I told, behaviorally it's very difficult because you'll always be tempted to either take out your money, go underweight is one. Second problem comes in investing newer money, because every time you have some new money, you are like, let me wait for a 5%, 10% correction, and hence this money gets accumulated. So both procrastination and panic selling is the biggest behavioral pitfall during a bubble, and which is exactly what I have also covered in my book in terms of what happens in a bull market. So this is exactly what I am seeing happening to a lot of people, that they are either not able to invest new money or they go underweight and they get caught. So this is my view. Then again, you can also have your own interpretation of these different indicators. But the key point is that if you have these four different lenses, and then you can derive your own interpretation. But my sense is, don't call a 10-20% fall a bubble. It happens. Like, if we don't want a 10-20% fall, then I mean, like, we shouldn't participate in equities. But obviously a 40-50% fall is something that we should all be worried about, and the probability of this goes high when all these four indicators become red. So and historically, when we studied the markets, we found that a fall of less than 30% happens only 5% of the time. So this is we did the Sensex data for a long period of time. So which means it's only 5% of the time. So, but we almost end up calling out for a bubble 95% of the time. So the key point is it's very rare. And unless all these four signals are red, and that is also combined with a trigger. The trigger can be some macroeconomic factor or some completely unknown factor coming from outside. So there can be different, or there is a debt leverage based, credit based crisis that is happening. So there are different formats of triggers that can happen, but broadly all these four becoming red with a negative trigger is usually what leads to a large correction. But when we identify a bubble, now obviously this is something that we internally run every month, but at some point in time we will definitely get worried and probably we will go underweight. But my point is, you should definitely get worried, but you should get worried only when these four, or at least in my view is that I will get worried only when these four will go red, and I will go on underweight only at that level. So right today is not that level where we think it's a bubble. There might be a 10-20% correction, which is always a possibility, but we think we are still in the middle of a multi-year bull market. Yeah, that's broadly it, Prince.
You summed up really well, and I must appreciate that. So, Arun, let me take a moment to read out the comments if I can. And so, one question is on Sid is asking, also put some light on small cap cycle.
See, small caps, again, we look at, the one is there are 4-5 lenses that we apply. One is a long cycle lens. Long cycle is already red. The short cycle said that once it crosses the second half of this year, right, it becomes very dangerous. So again, there also we are almost hitting the red. The valuations are very high. And again, sentiments are also very high because almost everybody is participating in small caps, except for the fact that the earnings growth will also be strong, because once the capex cycle starts, the small cap earnings growth is usually much stronger. So except for that one indicator, everything else is negative. So my sense is, I am very uncomfortable in small caps. In fact, we had tactically played it, but we are out of it, and we have shifted that portion of whatever we had in small cap exposure to banks and financial services. So we played that cycle for some time, but I think few months back, once we had that and again SEBI was concerned, and they raised some issues of, they said MFs have to publish their liquidity metrics and all that, but that could have been a trigger. But again, markets did not react for that. But again, my sense is, there are probably large caps are a lot better right now in terms of if you just look at it purely from a risk lens, my sense is you can get decent returns without taking much risk. But small caps, from here on, you will have to be on your toes, because at some level, you may need to be a little very, very careful on how you play small caps. But we are out of small caps. And as a strategy at our core portfolios, we don't play small caps. We only use it for our experimental high risk, high return bucket. So there also we tactically played, and then we are already out. So our view on small caps is that we think there are other better places where you can get decent returns with lower risk.
So Arun, although percentage is I'm not able to quantify in the question, but the promoter setting, how you're seeing it, because they are preferring dilution versus debt raising for their future money use or maybe capital.
Yeah, that is again one of the indicators. So that is definitely a negative because the promoter buying is also very, very low. And then promoter selling will eventually come in a large IPO cycle. So the IPO cycle is still not reached meaningful levels, but my sense is it'll over the next 1 year, if FII flows start and the IPO cycle starts, we will have to see for it. But right now it's still the flows, I will that this comes under the flows lens. I will get worried when the IPO cycle becomes a little more crazier, and the FIA flows start. So right now, because those two have not yet started, I don't worry. There are still instances, but at least at an aggregate level, it's not worrisome yet.
So how and exactly you quantify as you're speaking about the IPO cycle, like what all we need to gauge that we can say it is peaking out or it's at crazy
See,
levels?
one is you can look at it as a primary equity issuances. You can look at the 12-month rolling sum. If you plot the graph, you will get a neat graph, and then you will see that we are nowhere close to what we hit at 17 or probably 20. That is one. Or you can see it as a percentage of the overall market cap. So these two indicators can give you a rough sense of it. And again, you will also see very large issuances coming. There'll be a lot of craze around it, and so right now it's still nothing very large has happened, but broadly you can also get anecdotally you will get the pulse of it. But I think from a data point of view, we look at these two numbers, and then broadly it gives us a sense.
So, in you invest or maybe your fund invest in SMEs or not is a separate question, but altogether, how you're seeing the segment at this point in time, because there are opinions which are divided in the sense some people simply or bluntly call out that segment as a fraud or some kind of something wherein something fishy is happening, although it always happens across the market in all the segments. The quantum of that can be different. But again, what's your personal views on SME investing, how you see it and how it can fare from here? Any thoughts
See,
around that?
again, if that will be the most riskiest segment. So if small cap in itself is very risky at this juncture, SME is obviously even more riskier, and the kind of price moves that a lot of these SME stocks. See, it's a very simple thing that there is no large institutional investor tracks it. So which means it's still a very inefficient market. So which means you will get, if you can do some analysis, it can be a pocket where you can make a lot of money if you do the right analysis. But again, at this juncture, it looks extremely scary. So I am not very positive on that segment as such. But and again, if something goes wrong, right, it's not like the good companies will be spared. So, but my sense is that it's still too small a segment for any institutional money like MFs or PMS or FIA monies to get in. So it will still be predominantly a retail driven thing, and so which means it will still remain an inefficient market. So you'll have both extreme price moves on the up and down happening. So it's a very, very risky segment. The key is you should be very, very, unless and until you're a very experienced investor. My sense is stay away from that segment.
Right, we got one speaker, Ashok ji. So Ashok, you can unmute and ask your question. Mr. Ashok Singhi, you are still on mute. I think some issue. So Arun, one question in the comments is like the person is asking, where do you find value at this point in time? Any segments or maybe any pockets
See,
specifically?
right now we find value in the banking and financial sector. That is one, and the large caps generally look look okay. So I think banking and financial is definitely very attractive. That's the only segment which is probably trading at valuations below historical averages. The NPA problems are behind us. The credit growth cycle is picking up. Now, obviously, there are some issues with certain banks, and there are some specific issues, but like if you don't have a problem, you won't get good valuations, and if everything is going right, you get insanely high valuations. So you can't wish for both. But all you have to ask is, will this get solved over the next? If you take a 3-year view, after 3 years, will we be talking about this? So broadly, my sense is it looks very, very attractive, and the trigger can be FIIs coming back, because FIIs usually are a very, very large participant in the banking and financial sector. So I would personally, like we also have a tactical call on that. But out of all the segments, I personally like the banking and financial space at the current juncture.
And the focus on gold being a potential reserve currency and de-dollarizations is among the few things which are mostly talked about these days in global parlance. So, any thoughts around that? I mean, do you also factor in the de-dollarization which has just begun, and if we can quantify that going forward, what can be the potential changes it can do if it materializes big time?
See, I personally don't track this, and I find it very, very hard to gauge gold, because it's very, very hard to figure out what actually drives gold prices, because for some point in time it was tracking the US real yields. And suddenly in the last 3-4 years it stopped tracking that. So it's very, very hard to figure out what really drives gold price. And I've seen a lot of people say just keep 5%, 10% as a diversity. But my question is, if it's only 5%, right? Either way, let's say equity market tanks and then gold goes up by say 30%, 40%. That's still 5%. It hardly adds anything, right? So you either put meaningfully large amounts at say 25, 30%. But again, at 25, 30%, there was a period between 2012 to 18 where gold prices just did not move. So even for a 5, 10% allocation, I used to get a lot of flack from clients who were like, why in the world do we have gold? Why can't we remove? So what I've realized is, unlike equity where I can build a decent framework and at least know where we are in the cycle, I find it very difficult to figure out how to identify these gold cycles. So this goes into my too hard to play bucket. And as Indians, we will, whether we like it or not, we will anyway have a lot of gold via jewelry. So I don't want to again overcomplicate my portfolio with gold. So I don't personally have any gold through financial means. But if you are somebody who wants to play gold, I think SGBs can be a very, very, it's probably the best option to play gold. But to be honest, I've tried to build frameworks around how to track gold, but I've always been unsuccessful. And just like once you figure out something, then it stops to work. The real yields were something which was working almost from 2004. It was working perfectly. But again, in the last few months, because the the US yields went up and logically gold prices should have gone down, but somehow it didn't go. So I'm very, very confused on what really, and you can argue that then volatility came and there were wars and all happening. So which is why I'm saying that there's too many drivers for gold. And if you look at long periods of returns, if you look at 10, 15 year, it anyway underperforms equity. So we publish something called, it's called Wealth Conversations, which is available in our website. So you can, it's free, and then, it's almost like a 100-slide thing where every asset class gets covered and you can go check what happens in gold, right? And over long periods of time, over 15 to 20 years, gold historically has underperformed equities by say 3 to 6%, depending on which time you are measuring. So my sense is, over long periods of time, it underperforms gold. It underperforms equity, and it historically it's gone through 7, 8 year cycles where it just did not move. So if you get caught in the wrong cycle, it becomes very, very hard to know whether you have to stay with gold or not. So to be honest, I don't understand it. But purely from a diversification point of view, if somebody wants to put it, if you have a very, very large portfolio, then maybe 20% should be okay. But this 5% is is like, if you're just saying diversification, but it really doesn't move the needle. So if you want, you put at 15-20%. But otherwise, to take smaller allocations is unnecessary noise.
Right, Arun. And for our audience, I would sincerely request you guys for such insights. You can definitely give Arun a follow, and his book deserves more reading from all the market participants. And as a disclaimer, I have no association on promoting anything, but I sincerely believe the kind of data Arun evaluates and the kind of hard work he puts in. So definitely that should be appreciated, and you guys should definitely give him a follow so that you can be keeping updated whatever he shares, and even graphical representations also. So definitely you guys can do that. So Arun will close with the last question from one of the audience. So he's asking importance of maintaining cash in the bull market.
See, the way I kind of think about this is very simple. Uh, all of us, I mean, unless and until we are retired, right? Which I think most of us in this audience are probably not retired. So which means all of us will have a particular savings that we will continue to do. Like every month out of our salaries, we will have X amount that we are saving. So first thing I want all of us to know, or this is something that very simple, but it's something that blew my mind, that I realized it only after like 10-12 years, right? So which is that, so let's say I have 10 lakhs, okay? 10 lakhs is my portfolio. And I am able to save, say 50,000 every month. Okay. So which means the next 1 year, I will be able to save 6 lakhs. So which is effectively 60% of my portfolio becomes my incremental savings for the next 1 year. So assuming even if there is a bubble and then the market cracks, I still have, so I don't need to go underweight, because anyway, I am deploying 60% more next year. And let's say the bear market happens, and then market takes another 1-2 years to recover. So which means if it is 2 years, then suddenly I have almost 120% of my portfolio, coming as cash in the next 2 years, right? So the first thing that all of us need to do is that first figure out what percentage of your portfolio is going to incrementally come as savings in the next 1 year. So for some of us, it might be 20, for some of us, and in your early stages, you will realize that mostly your savings number is very large. But if your savings number is very low, so let's say if I am already built a very large portfolio, say I am at 10 crores, and then I am able to only add, say few, I mean, whatever, 10 lakhs, right? Then it's a paltry amount. Like then it means my incremental savings is hardly adding anything to my overall portfolio. In that case, you may need to think of asset allocation and then say, let me keep 30% in debt. Right? Even in a bull market, I will keep whatever, 20%, 30%. And that call has to be taken based on how much volatility can you put through, what is your time frame, and what is the overall 10, 12, 10, 15 year returns that you want your portfolio to make. But generally, once you reach larger sizes, my sense is at least keep 20-30% in debt, right? But for most of us, what will happen is that if you calculate the savings number, which will incrementally come the next 1 year, you will find that that's very large. So which means if that number is say 15%, so let's say for that same 10 lakh portfolio, or let's say I have 50 lakh portfolio, okay, and then I am able to add another 10 lakhs every year additionally. So which means in the next 2 years, 10 lakhs will roughly be 20% of my portfolio. So which means in the next 2 years, I still have 40% of my portfolio coming in as cash, right? So then you don't need to go underweight, because your incremental savings is large enough, right? So the key point is that this whole tendency to have cash needs to be put in context with what is your incremental savings over the next 1-2 years. And if you have reached a stage where your incremental savings is say sub 5% or sub 10% of your current portfolio, that is where you start thinking about asset allocation, and you say, I will always keep say 20% or 30% in debt. And this is something that you can, and anyway incrementally you'll have some savings cash which is coming in. And then you can say if there is a market fall by more than 20%, then I will start allocating some bit of my debt into equities. So this is broadly what you can do. But the key point is the savings number is something that a lot of us don't talk. But once you put that number, a lot of your life will become easier because you realize that all this unnecessary noise that you're dealing with in terms, then you don't even need to figure out where the market cycle is. You just stay invested because you are still in that phase where your savings is probably adding 40% returns. And then if the market does 10% or 15%, it is irrelevant because you are the actual growth for your portfolio. At some level, it will become difficult because once your portfolio becomes larger, your salaries might find it harder to match that, to get that incremental growth. But till that stage, make sure that you are focusing more on the earnings part from your work and also the savings part. And this is, I think, this is a very subtle thing, but it took a long time for me to realize. And once you realize it, your whole investment journey itself will become very, very simple.
Super thoughts, Arun, and I believe for the majority of the participants who just started, it's very relevant. They should understand the importance of increasing their earnings and definitely deploy more of their savings in the proper equity allocation or whatever suits them. So we got one speaker. Quickly, we take question from him and then we close for the day. So Magic, you can unmute and ask your question.
Yeah, good evening, Arun, and it was a wonderful insight. I had one question. I mean, you said we are in the fourth stage of this bull run. So you are expecting a correction, and what kind of correction are you thinking of? You said around 30% is a normal correction. So sometime next year you're expecting a 40-50% correction from
No,
here?
no, no. Okay. No. You can complete the question.
No,
Hello.
yeah, that is the first part. I
That's
mean,
it.
once
That's it.
yeah.
Okay. No. Actually, I wasn't. I wasn't talking about a correction. I was generally saying that a 10-20% correction always happens in Indian equity markets. Like if you look at the last 43 years of data, you can. I mean, like we publish a report called Wealth Conversation. You can. There's a interesting slide there. So I was just saying that 10-20% corrections are very, very normal, and only in very rare cases, once every 7-10 years, a large fall of a magnitude of say 50% plus happens, right? Now, when that 50% fall happens is usually in a bubble market kind of a condition where your earning cycle is in the last stage. Two, your valuations are very, very expensive. Three, your the liquidity is extreme. That is, FIAs are positive, DIAs are positive, IPOs are going crazy, and the last lens is sentiment lens when there's a lot of greed. Now we are probably in a zone where we are entering the greed zone on the final indicator, but flows we are still nowhere in the craziness. And the second, the valuations are a little expensive. There are two red indicators, but the earnings growth cycle, we are still in the mid phase of it. So only in the last stage we may have, so which means fundamentally the earnings growth can still remain decent in the next 3 to 5 years. So that's something that we'll have to track. So overall, putting all this together, our view is that we are not in a bubble. But that doesn't mean that there can't be a 10-20% correction because those are very common. But the odds of a 50% correction from these levels are very, very low is what we are meaning. So think about it like a driving a car. If you are over speeding, if you are drunk, and if you are going in bad roads, the odds of a accident is very high. So our sense is those kind of conditions are not there today. So the odds of a very large accident is very, very low. So we are not seeing any signs of a bubble in today's market. So which means the odds of a 50% fall is very, 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 very low unless and until something dramatically goes wrong in the world.
So, Arun, when you said BFSI space, where precisely we can assume? Is it the lending or non-lending, PSU, private bank, brokers, AMCs, insurance? It's a wide space. Can you, point out if you would
See,
like
I
to?
personally like private banks. But I mean, if you want to keep your life simple, you can just buy a simple the banking and financial services fund and let the fund manager figure this out. Or even if the environment changes, they can keep moving around which segment is more attractive. But personally, within this, I like the private banks space.
Right. So, Binod, quickly unmute and ask.
Yeah, sir. Sorry to, this could be last question. Just like about some of the sector yet not performed, like agriculture and the chemical and textile. So, do you still think that in a bubble market or in a bull market, this will happen to be like some sector will perform, or in bubble market all will perform, then fall will come?
See, again, I personally don't track these sectors. See, as I told, I just try to identify these the cycle, and then I have whatever is my asset allocation, right? So personally, for me, it's 90. For somebody, might be 70. And then in that, the next question is, how do you build a portfolio? So for that, what I personally do for our clients and for me, what we do is we split it across different investment styles. So we have quality as a style, we have value as a style, we have growth or blend as a style, then momentum and mid and small cap as a style. And then we figure out 5 good fund managers from each of these styles and then put them together and then let them ride the entire bull market. And only once we reach a bubble kind of a phase, we try to reduce some bit of equity and either park it in debt or kind of try to do some momentum oriented BAF. But so broadly, this is what we do. So internally, and then for the experimental bit, we are positive right now on the banking and financial space. But on the agri one, we don't have any funds to play it. Again, textiles, again, it's too small a sector, so we don't have any specific funds to play it. So generally, I try to play it through funds. So personally, I don't track these segments, and so I might not be the right person to comment on this.
Okay, no problem. Thanks for your insight.
Sure. Done. Thank you. Thank you so much.
Arun, I had a follow-up question because you did mention also that small caps, you are now not investing in small caps, and also you did mention that we are not in a bubble state. And also you did mention that small caps are the growth factor in this market. So I am a little bit confused on that.
Okay, so the broad call is always on the large cap space because that kind of represents the broader markets. Because if you look at 2018-19, right, while the large caps were not affected, you found that small and mid caps had corrected. In fact, small caps were down almost like 40-50%. So all we are saying is that all these indicators that we do is at a large cap or the top 100 kind of a stocks or top 50 is what gets represented. But there can always be possibilities of micro bubble might be a very harsh word, but micro problems or micro excess happening in different pockets. So you might have, sometimes it might happen in certain sectors, sometimes it might happen in certain market cap segments like mid caps or small caps. So in that sense, what we were saying is that at a large cap level, we don't see any signs of a bubble, but small caps, we are concerned on the valuations and you need to be extremely tactical and careful. So out of the 5-6 lenses that we use, except for one lens, which is the earnings growth lens, every other lens is showing red. So which means that for us to play it correctly and then come out is very, very hard. So we are not doing it. We played it tactically for some time. We made decent returns and then we are out of it. So from here on, it will be very, very hard. I mean, you need to have a clear exit strategy or otherwise it might become difficult because at some level, if there is some problem, right, small caps is generally illiquid. So which means whatever is a correction will be far more sharper in small caps. So we are not finding the space comfortable at this juncture. So the entire presentation which I discussed was broadly on the large cap space.
Okay. So, I mean, we haven't seen a bloat stage yet in the small caps. On that point, I think we are sure, no?
No, you're saying what stage are you saying?
I mean, a small cap blowout.
No,
Normally, when a
blowout has
bull,
not yet happened. No,
yes.
nothing has happened. But again, see, the idea is the risk is increasing. So if there is any trigger, right? I mean, you think about it like driving, right? Now, just because I am over speeding and I am a little drunk, doesn't mean that I will. You can say that will I meet with an accident in the next 5 minutes? I may not. I may still continue to drive peacefully for the next 1 hour. But as a general prudence, what will you say? That hey, now Arun is drunk. He is driving at very high speeds and he is also going in the night. So it's very risky. I don't want to travel in his car. I'm not saying he will meet with an accident, but the odds of him meeting with an accident is very high. So that's exactly how we are looking at small caps. Now, if you ask me, has small cap met with an accident? Definitely not. But will I want to travel in the car where the small caps are the driver? I don't want to. I want to travel in a car where large caps are the driver today. So that's the only nuance. Now, whether you want to travel and then you say, hey, till now nothing has happened, right? But again, as the more and more time you spend in that car, it becomes more and more riskier, and you never know what is that moment that this car driver, because some event has to happen, some dog has to cross the road, and then the small cap might find it difficult to navigate because you're already overspeeding, you are drunk, and the road conditions are not great. So this is the template that we use. So I'm not saying all these are true for small caps. So except for earnings growth, the other indicators are slightly getting on the negative or on the red zone. So which is why personally we are not doing it. So if you're doing it, be a lot more cautious and a lot more careful.
Thank you so much, Arun. That was
Sure.
a perfect answer, and I do understand that yes, risk management is now the right spot we are in. Thank you.
Sure. Thank you.
Thank
Thank
you
you so
so
much.
thank you so much. Thank you so much, Magic, and thanks, Arun, for extending it for another 15 minutes. So we'll close for the day. It was lovely interacting with you all the time, and definitely sometime down the line when there would be different market temperature and situation, would like to evaluate the situation with you, and it's really helpful, at least in these times wherein people are. Enjoying the returns, but on the back of their mind, they believe that this is not something usual happening, right? So, with that note, we'll close for the day. And those who are joining us for the first time, they can certainly follow our handle so that more such sessions can be accessed from our handles. And those who join late can also listen to the recording.